All right, looks live. What's up, everybody? My name is TJ McClellan. We're here for a Facebook Live video. We have the virtual display going on. If we're looking down here, it's because we have a Facebook Live feed on this computer. But for our content, we're going to try to shoot it out to this camera and out to the audience. So I have Brad Brown right next to me, and he is our guest speaker for tonight's All About Mortgages. So this is going to be amazing. We're going to give Brad here a second to introduce himself once we get to the slides, so give him just a second.
Hello, everybody, and thanks, TJ. I'm going to introduce myself. My name is Brad Brown. I've been doing mortgages for a very long time. I don't want to actually date it, but it's been probably as old as you are. I don't know, something like that.
I love that. Real quick, as you guys know, my name's TJ. There's a whole bunch of stuff here up on the screen. We've done over $150 million in deals. We know what we're talking about. Brad's probably done like 25 times that in loans. He's an amazing loan officer. So this one is all about Brad. So now go ahead and give us a little bit of background about Utah and where you grew up, or something about just you personally, so that we can connect with you.
All right, so I wasn't originally born in Utah. I was a Montana boy and then moved down to Utah. I moved after college. I moved to Albuquerque, New Mexico to be a finance officer for GM.
Okay.
GM was opening up their first mortgage division at the Woodlands on 7th East here in Salt Lake. And I put in for a transfer. I didn't get the transfer, but I moved up here anyway and started with mortgages. And it was just one of those things that seemed to be where I wanted to go. So, been doing mortgages since 96.
Whoa, 96? The late 1900s. Just kidding.
We did have electricity.
Now because me and Brad, we're kind of shooting it a little bit here, and also my mom, she's also with us. But Brad was saying that he has swam with real sharks. That's crazy. Give us a little tutorial. What's that like?
So we're talking scuba diving instead of finance sharks.
Yeah.
Yeah, to me it was always exciting, and it's always been exciting. But after I get done with it, I'm kind of like, that was really stupid. But it's fun, and I've never had any problems. I swam with sharks in Belize, and the last time was Bora Bora. So
wow, that's cool. So Brad's been all over the world, right?
Pretty well. I'm getting there.
Yeah, that's awesome. So even if you have a loan question or you have a world question, Brad's your go-to guy. All right, so we're going to get into tonight's material. So I'm going to get off the camera. I'm going to let Brad just run with this. So you guys are going to have a great time. If you guys are on the Facebook Live feed and you have a question, comment it down below. My mom is monitoring the chat channel so that you guys can get your questions answered. We will try to monitor and get every question answered as well. Also on the Facebook Live, there is a link on there for you to sign up for our $500 gift drawing. So if you guys want to enter into that, there's no purchase necessary. You just sign in and put your name in the hat. All right, let's get to it. Brad, take it away.
Okay. So the first thing we're going to talk about tonight is, identifying a couple of the terms. And first of all, everyone says, I need to go get a mortgage. So what is a mortgage? A mortgage is just a loan. It's a loan on property. So whenever you hear, hey, so-and-so is getting a loan, so-and-so is getting a mortgage. Mortgages are identified with a property. And to take that a little bit deeper, if you're getting a mortgage, you're also going to be getting a deed. The deed is the collateral for the mortgage. So basically, the deed's what's titled in the lender's name and your name. Until you pay off the mortgage, the deed is not clear. It has a lien against you. And that's the collateral that the lender has, so that, if something goes wrong with it, they get the house. The note is the third part of the mortgage. A lot of people, there's those three parts the loan, the deed, and the note. And the note is basically an IOU. So if you wondered what your note was in your mortgage package that you signed, your mortgage note is the terms which you agreed to. In other words, the repayment of the mortgage loan by monthly payments at a certain interest rate with a term that ends in so many years or months or whatever. Now, moving on from just what is a mortgage, where's our next slide? Okay. Let's go into types of mortgages. Yeah, you want me to read this?
Yep.
Did you know the first use of the word was for marriage in the 1300s? So TJ's giving us some fun facts here. If you have a mortgage and you wonder where it came from, it was used for marriage in the 1300s. In Scotland, a red door means fully paid off mortgage. So I guess if you paid off your mortgage, you could paint your door red and everyone would be like, woohoo. All right, 88% of buyers get a mortgage. So a lot of people. All right, types of mortgages. First of all, let's just talk about the types of mortgages. There's a ton of mortgages out there. You have fixed rate, adjustable, FHA, VA, conventional, and there are pros and cons that go with each one of these. Choosing a mortgage is like choosing a pizza. There are so many options, but you've got to pick the one that suits your taste and your budget. And that's really the bottom line. Whenever you go to get a mortgage, your loan officer takes all your information and then basically tries to determine which program, product, or type of loan fits you and your circumstances best. So, for example, you kind of divide the plethora of mortgage options out there into two categories. The first is government. So, government loans or government mortgages is a product type and a program that you can use. And specifically for people that want to use a government loan, you're looking at FHA, VA, or USDA. So if you're not using one of those, it's not a government loan. All the rest of them fall into the category of conventional loans. Conventional loans are Fannie Mae, Freddie Mac, jumbo loans, HELOCs, second mortgages, all of those. So they all fall into conventional loans, but then each category has specific circumstances. For example, if you don't have a lot of money, then you're going to probably do a loan that has a low down payment option, and typically that would be FHA, VA, or USDA. Now, conventional also has low down payment options. They do a 3% and a 5%. And it just depends on which program is best suited for you, whether it's FHA or conventional. In those instances, FHA has a lower interest rate, but higher mortgage insurance. Conventional has a higher interest rate, a lower mortgage insurance. So they kind of compete that way. So let's go into a couple of things on how the mortgage types would be categorized. So if you wanted to know what type of person am I, what type of mortgage do I qualify for, what's the best fit for me, you're going to need to kind of go through your own circumstances and tell your loan officer, hey, I've got this much money down, I've got, a good job, but my credit's a little dinged up, whatever. If you're in that category where you have a small down payment, maybe your credit's not quite perfect, and you've never bought a house before, first time buyer, you're probably going to be perfectly fit for an FHA loan. FHA has a little bit easier qualifying guideline. They also don't require a lot of money down, 3.5% on FHA. So if you're military, VA. VA's got a great program for military, especially. They can do 100% financing. So the only drawback to that is you can't do a VA loan if you're not military. So somebody says military, you think VA. And then USDA, these are borrowers that want to live in the boonies, okay? They want to live in rural areas. Best way to remember USDA, it's the same people that stamp your stake and say USDA. They also allow, this loan was originated basically for agricultural or farm, and rural people have a little bit different set of circumstances, so USDA stepped in and helps them out. That loan is a really good loan if you want to live in a rural area. You don't have to be a farmer. You can just be a regular Joe and go get one of those, but you have to live in the area that they're allowed. All right, so moving into Fannie and Freddie. Fannie and Freddie are great loans, especially for people that have, 20% down. But even between Fannie and Freddie, there's discrepancies or differences where each one of them will specialize in something. So like Freddie allows ADU, alternate or the dwelling units, I can't think of accessory dwelling units, thank you, that sit on your property. You can use the income from those to help qualify. They have different reserve requirements if you're buying rental properties. So those are two of the things you should probably keep in mind. When you talk to whoever it is that you're getting your loan through, make sure you identify what your goals are, what it is that you're looking to accomplish by doing a mortgage, and then give the specifics. They're working for you, not against you, and if you give them all the information, they can find the right mortgage and the right product that will fit your needs. So I think we're on to the next one. Principal interest term amortization, APR and interest rate versus APY. Escrow and PMI. Why does mortgage sound like a foreign language? Because sometimes it feels like you need Rosetta Stone to buy a home. It's really it's true. We speak a different language. There's a lot of things that are going on in a mortgage that we abbreviate, What's your DTI, what's your top ratio, your bottom ratio. So if you're not familiar with the mortgage terms, just ask. In fact, if you don't know, you can look up almost everything on any Google search and say, what does FHA stand for? What is APR versus APY? What is, all the different acronyms that go along with a mortgage, and there's a million. So without going into each and every one of them, the best thing to do is look up what the acronym is, and then you can talk about it. You know what? I wanted to touch on one other thing. So one of the best, we can go back to, one of the best ways to figure out if you qualify for a mortgage, there's two things that they want. The first thing, they want to make sure that you can pay back the loan, okay? So when you qualify, you need to know how much, you need to tell your loan officer everything, because no matter what you do, they want to know that they're going to get their mortgage paid back. And secondly, I don't really know how to explain this one, but it's risk. The second thing is, sure, you can pay back the mortgage, but how much risk is in the loan? Now, we determine risk by rate, we determine risk by your FICO score, we determine risk by your debt, we determine risk by a lot of different factors that make the mortgage either more expensive, harder to get, or even easier. So those are really big things to identify when you're looking for a mortgage. If you have banged up credit, you're gonna have a banged up interest rate. It's just wherever there's risk, there's an increase in cost. So those two things are always going to guide a lender on whether you're going to get approved or whether you're going to, have to go through a bunch of different conditions. Okay, so we are. So mortgages terms, principal, interest, term, and amortization. Amortization is over the life of the loan. You've got your principal and interest, and it's gonna amortize net to zero to the term. So basically, your amortization is 360 months. You're paying your front end of your interest up front. So 360 months is 30 years. That's the typical length of a mortgage. And everyone's like, I've been paying on this mortgage and it's hardly going down. In the first part, the easiest way to explain that is you're going to net to zero at the end of this 30-year period. At the first part, you're loaded with interest cost because it's split so that by the time you get to 360 months, it's zero. As you get about halfway through, it starts to pay more principal. You start paying down the loan a lot faster. And when it gets to the end, you're paying almost all principal and no interest. The interest rate is reason why I went back is the interest rate is determined by risk and by your ability to pay back the loan. There are mortgages out there where you don't have to show like your tax returns, but you still have to prove that you can repay the loan, whether it's in rental offset or whether it's in ADU unit or some type of additional income coming in from a trust or whatever. So remember, those are big things as far as whether you're going to have a good interest rate, if it's a funky loan, non-QM, something that has different features on it, like adjustable rate or a balloon payment. Those are usually considered risky features, and your interest rate's gonna be different. Okay, escrow and PMI. Escrow and PMI, private mortgage insurance and escrow. So if you have 20% down at the time you purchase your home, you'll probably get away from not having to have mortgage insurance. However, you'll still probably have escrow. Property taxes and homeowners insurance are escrowed, or they're taken out month by month so that by the time they're due, they're added to your mortgage payment, so your payment goes up by the escrow amount. And when those escrows are due, they take the whole amount out of that escrow account and pay them for you. That's if you escrow. A lot of people don't like to escrow. We offer all kinds of different programs that don't include escrowing. But if you have a loan that has escrow in it, the escrow payment is included in your monthly payment. So by the end of the, whenever your property taxes and your mortgage insurance, your homeowner's insurance is due, those will be paid by the mortgage company. And when you close, they will take that money out and pay those things up front, so you don't have to worry about it. I think that's about it.
Nice.
So getting pre-approved. This one's probably way more important than anyone puts the emphasis on. Most people think, oh, I'm good, I'll go talk to the loan officer, I'll get pre-approved later. But here's the thing, as TJ knows, you have to have a letter, you have to have an offer with a pre-approval letter. Now, if you call your mortgage person and you say, hey, I make $150,000, I've got, great credit, and, I've got 20% down. He can tell you that sounds great, and you are pre-qualified based off of what you said. Pre-qualified doesn't really mean anything, it's just what you tell the loan officer, and he can write a letter that says you're pre-qualified. However, pre-approved is proving it. You have to send in documentations, run your credit. There's basically, you're getting approved for that loan up front. If you get a pre-approval letter, you're likely to get a better chance at winning an offer than if you have a pre-qualification. So the difference between pre-qual and pre-approved, pre-qual is what you tell people you have. Pre-approved is what you can prove that you have, and what a loan officer can approve, can show the seller that you are approved with. Okay. And obviously the reason that's important, you're gonna win the deal if you have a pre-approval letter. So get pre-approved, it just makes the most sense. And in order to do that, think of it this way. If you haven't sent in any documentation to your lender, you're probably not pre-approved. There's a checklist of stuff that we ask for, tax returns, pay stub, bank statements, driver's licenses, social security cards, and we run credit. Once all that's done, you're likely going to get a pre-approval letter. If you haven't done any of those things, you're probably pre-qualified, and that's just not as strong. Okay. Getting pre-approved is like getting a fast pass at the theme park. It's not guaranteed right, but it sure helps you skip the line, and it helps everything go fast. So, good point. Okay, the purchase process: pre-approval, house hunting, applying for the loan, underwriting, and closing day. So, the process for getting a mortgage is probably not really exciting. People don't like to do it because it's a lot of, prep and work. But I can tell you, if you do go through the steps, the process goes really fast. We have been getting cleared to close in 7 to 8 days, and that's historic right now. I mean, most people, past it was 30, 60 days. So the way to do that is get pre-approved. Then, not before, then go house hunting. You call up your agent and say, I've got that letter, I can make the offer now. Then go house hunting. Okay, so you're pre-approved. All your loan officer has to do at this point is get an offer and match it up so that you can apply for the loan. The loan will not be a legitimate loan until you actually have a house. The 6 pieces of information we need. We actually have to have a house in order to write a loan. Once that's done, the loan officer submits you a package and you sign it, look it over, all the terms are disclosed, and then once you sign it, it goes to underwriting. What happens in underwriting is they look at all the stuff that you sent in and they approve the documentation is acceptable, or if not, they want questions answered, they put conditions on it. So 99% of the time we get approvals that have conditions. Those conditions are questions the underwriter wants answered. You're approved, but you have these conditions that have to be answered prior to closing. Everyone thinks there's, this is crazy, I've got all these conditions. They're just crossing T's and dotting I's. For example, you might have a pay raise in a certain year. And when you look at the last pay stub you have, it doesn't calculate. You can't make it match up. So you have to go back and figure out, hey, when did you get your pay raise? How much was it? They're just little things, but that's what they have to do. So when they get that done, you're in underwriting while the appraisal is being done. So we order the appraisal at the time you apply for the loan. That appraisal comes back, the underwriter approves, and then we can close. Once you sign the final closing CD, we have 3 days before we can close. A lot of times we'll get that out as soon as possible, and we'll have a closing right after that. that's pretty much it, isn't it?
Yep.
All right. Well, thanks, guys.
Oh, all right. There we go.
How did we do time-wise?
Let me jump up here real quick. All right, I'm back. All right, I just wanted to thank Brad for the amazing session here. So thank you so much for giving us some good instruction all about mortgages. I know that mortgages seem scary, so thank you for kind of shedding the light on that. Nobody learns it in high school. You don't really learn it from your parents unless your parents like talk to you about this kind of stuff. And so we're very grateful for industry leaders like Brad to help educate our clients and friends and family and help us kind of move into having a better success story to buy our next house or our first rental and things like that. And so I'm very grateful. So thank you so much, Brad.
Thank you.
Okay, we're going to wrap up here online. Love you guys, and we'll see you guys next time. Bye.